Hello everyone, welcome back. I'm Ruben Torrens, and lately I received a few questions regarding things such as donations, medical expenses, disabilities, things that you think or may tend to think that will help you to reduce your tax payable, to pay less income tax. If they can help you also to qualify or to increase the guaranteed income supplement. And the answer is, well, it depends. It depends what are we talking about. Because, for example, it can be a tax credit or it can be a deduction. And if it's a tax credit, it will help you to reduce your income tax payable, but it's not going to help you with a guaranteed income supplement. But if it's a deduction, it will help you with both. It will reduce your tax payable, and it can also potentially can help you to qualify for the guaranteed income supplement or to increase the guaranteed income supplement if you're already receiving it or partially receiving it. So let me show you how this works because it's a little bit confusing. So better to show you with some examples. To add to the confusions, there are two types of tax credits, refundable and non-refundable. When it comes to refundable tax, the refundable tax credits are the ones that you will get them no matter what. So they're paid to you, and you will recognize them. There are not too many of them. The GST, HST, for example, if you have very little income or no income at all, and you file an income tax, you will get your GST rebate. So this is a refundable tax credit because it's being paid to you. The Canada Workers Benefit, the Canada Child Benefit, another tax credit that depending on your income, it will be paid to you. The Canada Carbon Tax rebate and the refundable medical expense supplement. This is different than medical expenses. Medical expenses are a different tax credit, which is at a non-refundable tax credit, which is the regular medicines that you may buy during the year. Okay, medical, just basic medical stuff. But we're not going to get into details of the tax credit. And the reason being that when we go to non-refundable tax credits, well, there is tons of them. So non-refundable tax credits, what do? They help you to reduce tax payable. But if you don't have any tax payable, like if your income is little or you have no income, there is no benefit at all to you on this type of tax credit. And what tax credits are there donations, the disabilities, the medical expenses. There is a lot more tax credits that are non-refundable. There are over 400 tax credits in Canada that are not refundable. So we're not going to get into this. So you know that we have two types of tax credits that they one is paid to you, which is the refundable tax credit, and the non-refundable will reduce your tax payable but does not reduce your income. So then we have deductions. Deductions reduce your income. Okay, so what do? They reduce your income amount and they reduce because now you have less income, you pay less tax. Okay, but these are different than tax credits. These are the most common deductions are RSP, the Registered Retirement Savings Plan, or Registered Pension Plan contributions. You contribute, you save money for your future, and you deduct this from your income. Say you earn $50,000 this year, you deposit $10,000 in RSPs, you pay taxes on $40,000. Okay, we're going to get into that example in a couple of minutes. So childcare expenses, that's another deduction. Interest paid on investment loans or mortgages on second property. If you buy a property for investment purposes, that you will gain something because you will have rental income, then the interest paid on that property, on that mortgage, on that particular mortgage, becomes deductible, becomes a deduction from income. And self-employment expenses, if you're self-employed, whatever expenses you have for your practice, for your business, then is deducted from the gross self-employment income. And this is how it works. Here is how it works. Let's see, compare tax rates versus deductions. So if you have an $80,000 income, and I calculated this for the province of Ontario, but it just differs in the amount of income tax that you were paying. It changes the numbers a little bit only. If you in Ontario you earn $80,000, you pay in 2024, $15,556 of income tax. And if you have a tax credit, say, of $1,000 because you made a donation, and but not a donation of $1,000, it's very different. This is the tax credit, okay? In order to have a tax credit of $1,000 or a donation, you need to make a donation of about 2,000, okay, give or take. This is not exact numbers. Then what does it do? The tax credit reduces tax payable. So your your tax payable goes down from 15,556 to 14,556. So you say because you have a $1,000 tax credit. If you have the same income, $80,000, well, you will be paying the same tax. But if you have a deduction, say an RRSP contribution of $10,000, now you have a net income of $70,000, and therefore, because $70,000 pays less tax, you will pay a little bit less tax. So what is the difference? This is important. So if your $80,000 of income will have a tax liability of $15,556, but your $70,000 of income, it pays only $12,591. If we see how much you save in income tax, you save in this case $2,965, or this number is very important, 29.65% of the $10,000 RRSP contribution. Why is this important? Because when you are retired, this is while you're working, but when you are retired, remember, we're talking about the guaranteed income supplement here. Here is what happens with your RRSP contribution after retirement. If you have a deduction, RRSP is the most common deduction. Okay, so if you are retired, if you're over the age of 65, you're receiving all-day security, say maximum all-day security, $713. Canada pension plan, let's assume, I just invented this number, let's assume this person receiving just above average Canada pension plan, $800 per month, and it has an RRSP account that converted into a RIF. This person is retired already and withdrawing $1,000 per month from the RIF. So under this scenario, the guaranteed income supplement will be 43 cents per month. It will be basically nothing. Okay, so, and if it doesn't make any RRSP contributions, we'll have a total of $2,513 per month. What happens if this person decides to make an RRSP contribution and say, receive the same all-day security, the same Canada pension plan, and the same RIF? This is the same situation. But now we will see a much larger guaranteed income supplement, $507. Why? Because it decided to make a contribution equal to $1,000 per month, equal to the RIF amount. This individual has discovered that he has on his income tax RRSP contribution room, and he watches one of my videos, and he said, I'm going to put some money in RRSP to see if that makes me qualify for the guaranteed income supplement or for a larger guaranteed income supplement. So it will work the whole of, it will be retired the whole of 2024. It will receive $12,000 in RIF during 2024, and by February 2025, will make a $12,000 RRSP contribution, which is going to be equal to the money that he received from RIF in 2024, and then file the income tax. So by doing this, what is it doing? In July of 2025 and until June of 2026, the GIS will increase by $507 per month and 4 cents. So that will make him a total income of $3,020. Now, if we do the same thing that we did before, we take the $3,020 received per month, and we take away the money that we would have received without the RRSP contribution, we find out that it's receiving $507 per month more for a 12-month period, which is equal to $6,084.48, or 50.7% of the RRSP contribution. Remember, the $10,000 contribution he created on an $80,000 income a tax savings of 29.65%. Now, the $12,000 RRSP contribution, in this case, under this scenario, and but for a person that is over the age of 65 and retired already, it makes a return of 50.7% of the RRSP contribution, not in tax payable, but in pension payable and guaranteed income supplement. So how do you know if you can take advantage of this? And you can figure that out by using my calculators, the calculators on my website. Let me show you how that works. You can calculate your own guaranteed income supplement by using these calculators that I have online. If you've never been to my website, pensionbooster.ca, don't worry about the link. Will be on the descriptions of the video just below the video. And you can go into the website and register for free and start using these calculators. There is on the website, there is a tutorial video on how to use them. Okay, I'm using calculator number one first, and this is a little bit confusing. I'm currently working on making a change to this calculator to make this easier. Okay, make sure when you use the calculators that you read what it says here on this side, because each blue cell is the blue cells are the cells that you can change the information. Okay, so make sure that you read all this information. I'm not going to go into details now. You can watch the tutorial video on the website if you need to. But we will use the same case, $713 per month of all-day security, and we said that this person was receiving $800 per month of Canada pension plan and $1,000 per month from the RIF. And if we recalculate, every time you enter information here, you have to recalculate down here. You will see that this person will receive 43 cents per month of guaranteed income supplement. Okay, and we said that if the RRSP contribution is a deduction, so that means that if this individual contributes $12,000 into RRSPs, which is equal to $1,000 per month, so then what we do is we reduce $1,000 per month here and we bring it down to zero. We recalculate, and you'll see that the guaranteed income supplement now is $507 per month. Let's say doesn't want to or doesn't have the money or does not have enough contribution room and wants to contribute $6,000 into RRSP, which is $500 per month, okay, $6,000 per year, and we recalculate, and it will recalculate again the guaranteed income supplement. So make sure that you use this, and to reduce, you will reduce the whatever type of income you have. Let me give you another example. Let's say this is zero here, and it has employment income or net self-employment income of $1,000 per month. If you have this income, which is different than RIF income, so then the guaranteed income supplement is not going to decrease that much. So it's going to decrease very little. Now, if you remove this income because you make an RRSP contribution of $12,000, it doesn't make such an impact. So you have to be careful which line are you using, which type of income you're using. This is why it's so important to read what it says here on this side for each and every line. This is for a single individual. Well, what happens if it's a couple? Well, if it's a couple where both spouses are 65 or over, you have to remember you have to be age 65 in order to qualify for all the security, and therefore you need to be age 65 to qualify for guaranteed income supplement as well. Same thing again, it's the same situation. You will do the same, enter whatever amount you receive from Canada Pension Plan. Remember that you can do a lot of planning with these calculators, because you can say, well, what happens if I do not take the Canada Pension Plan and I postpone it up to age 70? Well, just leave the Canada Pension Plan in zero. That's all it happens. And what happens if I don't I don't convert my RRSP into RIF, and I wait until age 70 or age 71? Just leave it at zero, and then you get maximum guaranteed income supplement. What happens if I don't have 40 years of Canadian residency, I only have 30 years of Canadian residency? Well, recalculate that, and will increase will decrease the amount of all the security and will increase the amount of guaranteed income supplement for that individual as long as you qualify for the supplement. And then if one spouse is age 65 or over and the other spouse hasn't even made it to age 60, is 59 or under, then you will use this other calculator, and calculator number 4 will be for a couple where one spouse is age 65 or over, and the other spouse is between age 60 and 64. And for this topic, calculator number 5 is not applicable because this calculator is designed for survivor, a widow that is age 60 to age 64. So use the calculators in the way they are. I know they're a little bit confusing, but I'm currently working on making changes to it to add another line for deductions or RRSP contributions. So this is going to make it easier for you because you won't have to uh, juggle between the lines and seeing which line you're going to cut it down. So it's going to be easier. But it's going to take a few days, guys, because I got to go on a trip. And when I come back on the first week of June, well, by the end of the first week of June, then I will send it to my webmaster to make the changes, and we'll announce the changes on a separate video. In the meantime, make sure that you subscribe to the channel. It's going to help me a lot, and it's going to help you not to miss any future videos. This helps me a lot. A lot of people is watching my videos, but not a lot of people is subscribing. It's free, guys. Doesn't cost you anything. Just it doesn't take any time. Just click on the button subscribe, and you're gonna contribute a lot to the cause. And in the meantime, thank you for watching. I'll see you after the first week of June on the new video, and hopefully announcing the changes and the upgrade to the calculators. Thanks again, and we'll see you soon.